We're having a look at the UK growth figures this morning because they've just come out and they're not doing too great. And then we're going to move on to what would happen if there were a war to be declared between China and Taiwan. How would markets look? It's quite an interesting question. We're going to take a deeper look at that. And then today's Trading Takeout is that stock markets are not the economy. Before we get into today's video, though, make sure you hit subscribe and like this video so I pop up in your YouTube feed every day so that you can maintain your trading edge. So UK growth data has come out this morning and it's not looking the best, to be quite fair with you. The month-on-month figure was negative 0.3%. The quarterly was flat though, so no growth, but no decline in growth either. So we are doing slightly better than other European economies, for example. Absolutely nowhere near what the US is doing though. So the US is up at 5.2% year-on-year growth, which is absolutely insane. And we're kind of languid at around, I think it's about 0.3%. There we go. Expected 0.6. So we missed there even. The US is just doing absolutely insanely well. Like it's actually quite mesmerizing. And the problem is that the other components of this aren't actually doing too well either. If you look, for example, down here at the UK manufacturing output, 0.8% versus expected 1.9%. Construction output, negative 0.5% versus expected negative 0.2%. Industrial output, again, 0.4% versus expected 1.1%. So none of it's very good. And it's very much looking like a broader European issue here with regards to declining data, while the US basically just sucks up all the good stuff. I don't really know what to say about it, to be honest with you. But with regards to sterling, let's take a look very quickly. Sterling is indeed off. It's off this morning by, let's have a look, about 31 basis points, so 0.3% it's off by. And if we were to, look a little bit deeper at whether there's any sort of activity here that we could take advantage of, right now, in my view, no, there's not. I think what we'd be probably looking at if there were to be one is a sort of breakdown through here, and then looking at these levels here. So we're looking at 1.24, just call it 1.245, and this key one right here, which is 1.23, say 75 as well. So this is a double bottom. They're always lovely, lovely targets to get hit. And so what I would be looking at is potentially for a cascade through here. It's not a huge move down to this initial level. It's only about 50 ticks or so, but this is the broader one. And this is what tends to not need to be attacked, but tends to be attacked when you see something like this, double bottom into sort of a key area here. If we highlight this key area, all through there's sort of some resistance, some support here, and then this is sort of a bit of resistance as well. So this is how I'd be looking at it. Not great for the euro, for the pound. Sorry, I'm too used to saying not great for the euro. But alternatively, what there might be is a reach down here, and then people getting short for the break, and then it bounces up, which tends to happen most of the time. Actually, what we might actually have to look for is whether dollar strength comes into it and shifts the market down a little bit further. We did have inflation bang in line yesterday, so there's no real risk there of any broader surprise. We spoke about broader surprise yesterday, but there's no real risk of broader surprise there just yet. And if we take a very brief look at today's calendar, anything coming out for the US, there is the PPI numbers. Whether that should really affect inflation, not so sure. Whether that should really affect the dollar, not so sure. if you recall, last month or the month before, we actually had the PPI before the CPI, which was quite interesting. And that gave a very good gauge of where the CPI was going. This time, I think we're quite clear that it's probably going to be at around 2.2%. If it comes in softer, then expect that reversion perhaps on sterling, so we get a bounce. If it comes in a lot harder, because PPI tends to lead CPI, it could be a trade for that one spot 2375 level, a little bit higher over the next week or so, not right away. It's not just going to go like that. But yeah, that's how I'd be looking at the market. Basically, the UK growth is slowing down. But on a broader sense, it's just a bit flat. It's not doing anything really. So we're just doing a bit of crap. I'm not saying this to get anyone scared or anything, but I want to have a look at what might happen if a war between China and Taiwan were to kick off. And a bit of a proxy here is obviously that the US would heavily be involved, as well as other allies. But China's Taiwan Affairs Office spokesman overnight said once a war breaks out across the Taiwan Straits due to Taiwan independence or external forces intervention, i.e. the US, Taiwan will become a battlefield and the people in the island will become cannon fodder. He goes on to say some US politicians are putting China's Taiwan together with countries currently engulfed in war. What are they planning? Do they want to turn the island of Taiwan into a battlefield like those countries? Once a war breaks out across the Taiwan Straits due to Taiwan independence or external forces intervention, Taiwan will become a battlefield and the people in the island will become cannon fodder, said Zhu Feng Lian, spokesperson for the Taiwan Affairs Office. And this was in response to the US potentially passing a budget funding the support of Taiwan, Israel, and Ukraine. So clearly there is some propaganda going on here, right? It's definitely something which would concern China if the US is passing, any kind of budget to support Taiwan. It's clearly going to be defense related. It's going to be military related. China might see that as aggression. On the other hand, though, China almost might want a war, which is very, very bizarre, because then it would signify the sort of multipolarity thing that's been going on. It would cause their allies to become even more entrenched, and it would create isolation versus the US, almost like a Cold War experienced in the 60s, 70s, etc. And it would be very, very interesting from a market's perspective, because what we would see is some serious action in the treasury market. Now, my biggest thing here would be what would happen to the US 10-year yield, because China is, a massive, massive holder of US treasuries, firstly, because they do so much trade with the US. They basically take all the dollars that, Americans use to buy Chinese goods with. You have to buy yuan. So obviously the yuan trade is, okay, I want to buy something from China. I swap my dollars for yuan. China then takes those dollars, puts them and rebuys US treasuries to earn the yield. So they hold over, I think it's a couple of trillion or maybe just over $1 trillion worth of US treasuries to earn yield basically back on their dollar holdings from trade. So obviously if a war were to break out between China and Taiwan, there's going to be trade sanctions and things like that, similar to what we've seen with Ukraine, Russia. And so what's going to happen is that flow of US treasury buying is probably going to dry up quite quickly. Now, if we go back to when the Russia war kicks off, and admittedly we were in the middle of a rate hike cycle, but that was, when did that kick off? Russia, let me just have a quick Google just to get the exact specific date. God, Google's become awful these days. 24th of Feb. Okay. So if we go back to the 24th of Feb 2022, which is this week, basically. So if we go here, Monday 28th of Feb, 21st, middle of there, okay. Yields, in fact, fell straight away because people were buying protection clearly on the initial, war breaking out. So people were buying the 10-year Treasury bond, which causes the yield to then fall. But then we were in the middle of a rate hike cycle as well. So I think the overpowering nature there was different. What I would expect is I would expect a completely different outcome here. I would expect yields to rally heavily, and I mean maybe 100 basis points heavily, so 1% heavily. It would really, really cause issues. And then people would have to go and swarm in and buy protections. They'd be buying then Treasury bonds that would be on the market, because I would presume that China would no longer be doing trade with the US. They would no longer require that transition from dollars into US Treasuries. What you might also see is a broader equity market breakup as well as these yields rally. In my view, you'd see something very, very similar to 2020. Let's just put it that way. So you would see, in fact, it doesn't show quite the starkness of that. So if we look at here, exactly here, so March 2020, this is when, this is probably the closest sort of display of what I'm thinking, is we would see the extreme rally, right? And then even in this week, the extreme rally, massive bond volatility, and then it just gets suppressed because people are buying protection. Okay, so that is effectively what I would presume would happen. And in equities, if there were to be a war, you would see the market probably go no bid for a little while. You'd maybe see talk of the US Treasury, the Fed having to step in, because things would be just completely haywire. Things would be so dislocated that you just wouldn't know. And this is what I'm talking about, a full-scale war here. I'm not just talking about, some conflicts. Every single month you hear of Chinese planes flying into Taiwan airspace. That is totally irrelevant. That is almost an exercise these days. Yet people still get hyped up over it. The other big thing would be semiconductors. So you would see things like Taiwan Semiconductor Corp. I'm not sure why it's not listed here. Let's just go for NVIDIA, actually. I think you would see the semiconductors really get battered. But then obviously the US semiconductor industry would be a great buy after that. But the biggest concern would, probably be you'd want to sell the hell out of Apple, purely because that's where the chips are made. Foxconn's a Chinese company, although they have relocated some production out of China to places like, I think they've gone to India now, Vietnam. I think there would be a massive dislocation with Apple. So it's important just to note, which companies would be most affected, but also having the broader view on the bond market. The bond market does rule everything at the end of the day. It's what's controlled by the central banks, supremely. So having a good grasp on that should be able to serve you well. But this is a completely hypothetical situation, but it's always good to game scenarios out in your head, just so you can start building a picture of, okay, what happens if the worst does happen? I'm constantly doing that. I'm constantly hypothesizing so that if something does come, I've already thought about it. I've got a little bit of, subconscious there, a bit of memory there, and I know what to do. Whether it's, taking a trade or whether it's actually just flattening off, getting out of positions, going to cash, because that is a position at the end of the day. It's just key to have these situations sort of mapped out in your head so you can be a bit more nimble. The stock market is not the economy. That's today's Trading Takeout. And I really want you to understand this, purely because people get stuck with the thinking that bad data automatically should send stocks or even other markets down. See, what really matters is liquidity. How much liquidity has been in the economy? How much liquidity is still there? How much is being withdrawn or potentially added? See, right now, what people in Germany, for example, might be betting on is that the ECB has to cut rates, which is why the DAX is at all-time highs, even though German data is so bad. And it could be the same in the US. You know, people are used to having low interest rates. So when it hits 5%, but growth is still high, they're saying, well, the only way is down. We may as well stay long. Please keep this at the forefront of your mind so you stop getting confused as to why the market's going up.